Hey everyone, it's Amit. So the last couple of videos that I've done have been very focused on the housing market and the impact of the housing market onto people's primary homes. Well, guess what? This craziness that is being experienced in the primary home market is also being experienced in the second home market. And when I'm talking about second homes, what I'm specifically referring to are vacation properties, vacation homes, potentially even vacation rentals, but I'll go into that into a little bit more detail here shortly. Some of this is being directly attributable to the global health crisis, as employers have offered their employees with greater flexibility in terms of where it is that they want to work from. Employees have taken matters into their own hands and are perhaps looking for vistas beyond what they have in their primary homes to potentially work from. So according to the National Association of Realtors, vacation home sales rose by 16% in 2020 from the year before, outpacing overall growth in existing home sales last year, which was 5.6%. And the trend has continued into this year, with sales already up 33% in April relative to April of last year. And this has also been happening on the demand side, okay? On the demand side, the demand for second home sales is up 128%, while the demand for primary homes is only up a measly 34% on a relative basis in April of this year relative to April of last year. And people are expecting this trend to basically continue, okay, as employers continue to offer their employees with greater flexibility in terms of where they can work from on an ongoing basis, and employees continue to demand that level of flexibility as well. But with all of that said, this has resulted in a significant amount of confusion in terms of what is a second home relative to what is an investment property. Frequently, these things are being considered together, or like they may be potentially overlapping, but there are significant differences between the two of them. There are significant differences when it relates to the property and the mortgages that you can get, and of course the tax deductibility and the write-off situation on the back end as well. And if people are not aware of the differences between a second home versus an investment property, it could be quite an awkward 2022 tax season when we get into that particular stage as well. So that's specifically what I want to talk about in this video, the differences between a second home and that of an investment property, and we'll cover this from a variety of different angles. But before I get too far into it, don't forget to just gently click on that like button for the YouTube algorithm, as it'll greatly help me out, and of course subscribe to the channel and ring that notification bell as well, and let's get into it. Perhaps the most important part of this video is understanding the very concept of intent as it relates to a second home versus an investment property, because once you get this part of it basically hashed out and fully baked, everything else related to this, whether it comes to qualifications, whether it comes to mortgage requirements, or whether it comes to tax deductibility, is all a natural consequence of this intent, okay? So what do I mean by intent? It is very important that before you go ahead and execute the purchase of a second home, you have a clear understanding of what it is that you're going to be utilizing the second home for. Is it going to be a place where you potentially go quite often during the course of the year, or potentially even stay at for significant portions of the year? Or is it going to be a property that you are going to derive some form of income from, okay? So some form of incomes could be in the context of, like, say, rental income, or it could be something else, is that you're going to flip the property around and pick up a significant amount of gain on it. That understanding is absolutely critical, because in one case, in the event that it's going to be a vacation property, you're just going to stay there for a significant portion of the year, it would meet the definitional requirement of a second home. But if there is any form of income that is basically associated with it, you start dovetailing into the world of an investment property, and we'll talk about what more those differences are shortly here as well. So once we kind of like understand what the intent is in terms of how you're actually going to utilize the property, the next thing to basically understand is what qualifies for a second home relative to what qualifies for an investment property. So for a second home, let's talk about that first. If there is rental income for 14 days or less, rental income is exempt from tax reporting purposes. So this is a situation where you can own this home for vacation property, as a vacation property, and you can rent it out for a very small portion of the year, and all of that the IRS does not give two hoots about. If you personally use the place for more than 14 days, however, or more than 10% of the number of days days it is rented, whichever is more, it can be considered a personal residence or a second home. This means that if you experience any losses in the property, rental income or otherwise, it cannot be deducted for IRS tax purposes. Now, as it relates to investment properties, if you personally live in your second home for 14 days or less than 10% of the days it is rented during the year, whichever is more, it would be considered investment property, and up to $25,000 in losses is basically deductible each year. But now that we understand the intent as well as the qualification aspects of a second home relative to an investment property, let's talk about some of the unique differences from a mortgage perspective as it relates to these two classifications. So needless to say, credit requirements in terms of in terms of an individual's credit score is obviously going to be more stringent in either of these fact patterns relative to, say, a primary home, okay? And that's pretty obvious because you generally have a less of a vested interest than your primary rooftop that is over your head. The credit requirements are definitely more significant for second homes as well as for investment properties. Similarly, mortgage and interest rates in themselves, they're a lot higher for second homes, and they're even higher, generally speaking, for investment properties, okay? And it's really for that same reason. The banks that basically issue these loans know that you have lesser of a vested interest to basically continue to make the payments on an investment property in the event things go bad relative to what you may have on the primary rooftop over your head. When it comes to putting in down payments, generally speaking, when it comes to your primary homes, you may put in a down payment of like 3% even. Some of these FHA loans are absolutely insane. But with that said, when it comes to your second homes, the requirement may be up to like something like 10%, still fairly reasonable, and there is a PMI component that the lender can potentially satisfy as well. But when it comes to your investment property, that stuff is out the door, okay? You need to come in with 20% and potentially even more, like 25% down payment on those types of properties, okay? So you're putting in a lot more money on investment properties to basically satisfy the lender in terms of how serious you are on that particular purchase relative to something else, or relative to a second home or a primary home for that matter. And there's a couple of other things as well from a mortgage requirements perspective, and some of these are fairly intuitive, of course, because in a second home for that matter, the lender definitely wants to see or wants to ensure that you can cover the costs on both your primary residence as well as your secondary home, right? So we're talking about like your principal, your interest, your taxes, your homeowner's insurance, all of that good stuff. They want to make sure that you have sufficient amount of cash flow such that you can basically cover it off. When it comes to your investment property, the requirements are quite significant. They are similar in the regard that they're expecting you to be able to cover the costs associated with all of your properties for that matter, but they may also be looking incrementally for some level of property management type of experience as well. And typically, lenders such as Rocket Mortgage require a debt to income of 43% or less to get pre-approved or to get approved for a second mortgage. But when you're talking about investment properties, what investment properties or the lenders can potentially allow you to do is they can take into account potential future rental income on that property, okay? So what I'm specifically referring to there is they'll get an appraiser out there, somebody who's fairly specialized, can do rental comps in a given area, see what may potentially be generated from that given rental property, and then accompany that as potential income in terms of making your request for that loan a lot more substantial. Now let's talk about everybody's favorite topic, right? Which is taxes, okay? And taxes can be quite complicated in this particular realm, and as always, it's always beneficial to consult with a tax professional when you go about entering into any of these types of agreements, okay? But when it comes to second homes, you do have the opportunity, say your intent potentially changes, to convert your second home or change the occupancy status from a second home to an investment property. That can happen, but generally speaking, if you're going to do something such as that, wait for at least a year, right? So it does not appear that you were doing something untoward with your potential lender, okay? Because as I've said, when it comes to investment properties, they're coming in at a higher interest rates. They're requiring greater down payments. They're requiring all of these things, right? So if you're misrepresenting yourself as a second home when it's actually an investment property, it's going to be a problem, okay? So you generally want to wait at least for a year, maybe even longer, before you potentially change this occupancy status from second home to an investment property. The other aspect of this as it relates to taxes on a second home, as we talked about, right? If it's under 14 days or that 10% of rental day number, if those fact patterns do basically arise, then any rental income that you basically receive on the property does not have to be reported for IRS purposes, okay? So that is a significant benefit in that particular realm. But when it comes to your investment properties, on that front, absolutely all rental income that you generate has to be reported to the IRS. Now, when you have rental income, you also have rental-based deductions, right? So when you have deductions associated with maintaining the property, such as advertising or any repairs and things like that that you may potentially have to do, all of that is deductible and can be an offset to that rental income when you are doing an investment property. Now, as we're talking about deductibility and this and that, right? When it comes to your second home, the mortgage interest on that property, which is very similar to the mortgage interest on your primary property, is also all deductible up to a limit of $750,000 in debt, right? So that is a bit of a good news and sometimes unexpected, because there's some level of lack of sophistication where people potentially assume that interest and taxes on their second homes is not deductible. Now, when you're looking at it from an investment property perspective, all the interest associated with that property is, of course, deductible. Now, when it comes to property taxes, there was this tax law that was passed in 2018 or so that basically puts a cap of $10,000 on property taxes, right? So if you're incurring more in property taxes on your primary and secondary home on that, relative to that $10,000, it becomes non-deductible, but you can deduct up to $10,000, okay? So this can be a significant problem for certain states where there are significantly higher property taxes, because people may be exceeding that $10,000 number on their primary home itself, so then their taxes associated with their secondary home or their second home is not going to be tax deductible at all. This is very different from investment property, because similar to how interest on your investment property is fully deductible irrespective of a cap, your taxes or your property taxes are also deductible irrespective of that cap. And now what you also have when you have an investment property is depreciation. You can also use depreciation as an expense annually, i.e. year over year, to potentially offset your rental income as well. I know I mentioned this earlier, but you should always consult a tax counsel or a tax lawyer if potentially needed as well, especially if the scale of your investment properties continues to expand, on the best way to potentially settle a lot of these things up, okay? Because the more investment properties you have, you may go down the path of potentially setting up an LLC and reducing your liability to yourself as well as to some of your other properties in that manner as well. So there are certain other ways around it, but these are like the core tax differences and the mortgage and interest rate differences between these two types of properties, i.e. a second home relative to an investment property. So like anything else, there's pros and cons. The biggest pros, of course, on the second home is you get a really low mortgage rate, i.e. historically low mortgage rates in the environment that we are in, and relatively low down payment type of requirements as well. But when it comes to investment properties, of course, there's a whole host of deductions that you can potentially take advantage of. Hopefully, you got some value out of it. Of course, if you did, don't forget to smash the like button for the YouTube algo, subscribe to the channel, and I'll of course see you in the next one next week.